Hello, this is Pat O'Connor, and this video is part of a series about the Harvey Tax Refund Program. And the subject of this video is, what is a casualty loss? Now, first of all, no one has to die to qualify for a casualty loss, so there's no death required, and even, unfortunately, the death of a pet does not qualify for a casualty loss. Now, I think one of the most traumatic experiences many of us have in life is the death of a pet, but the IRS is just not going to give up on that one. So what is a casualty loss? Well, a casualty loss occurs when there is a sudden and unexpected event that damages property. So it could include flooding, fire, hurricanes, lightning, tornadoes. It could include a burst pipe, a broken pipe that floods a property and causes extensive damage. It could be caused by a car that runs into a building at 100 miles per hour. Think of how much damage that would cause, and that's certainly sudden. So it could be any of these things. So that can be the precipitating event. Now, what is a casualty loss from federal tax purposes? Well, a casualty loss for federal tax purposes is the difference between the value of the property before the casualty or the event and the value after. So in some cases, the difference is just going to be the cost, what appraisers call the cost to cure, the cost to fix the property and to tear out what's rotten and to put back new materials. But for homes and business property, the cost to cure is only a part of the diminution of value. There's also a reduction in value for the entrepreneurial profit that's necessary to entice someone to buy a flooded house and do the construction. There's about 15 different types of risks that are involved in buying a flooded property, renovating it, and then selling it. And so someone who is buying such a property is not going to pay the price of the property after it's fixed, less the cost of renovation. They're going to want a meaningful discount below that to take on those risks and to do the work that's involved. So that's what a casualty loss is. It's the difference before the casualty and after of property, and you can take it as a deduction. If it's business related, you can take 100% of it as a deduction. If it's not business related, you may have to reduce it by $100, and don't ask me where the $100 comes from, but $100 and 10% of your adjusted gross income. For many Harvey victims of Harvey and Irma, we believe the federal government is going to waive the 10% of adjusted gross income change. So that is a casualty loss. If you want to see if you qualify, go to harveyrefund.com and fill out the application, and we'll be back with you shortly, and we'll let you know if you qualify for a Harvey refund or not. This is Pat O'Connor. Thanks for watching.